$5,147. That is where gold is trading right now, today, March 12, 2026, while the US dollar is bouncing. While the DXY just surged to a 3-month high. While everything that's supposed to push gold down is doing exactly what it's supposed to do. And gold is still sitting at $5,147 an ounce. If you've been watching markets for any length of time, you know that gold and the dollar are supposed to move opposite each other. The dollar goes up, gold goes down. That's the rule. That's been the rule for decades. So when I tell you that gold hit $5,595 on January 29th of this year, a price that would have sounded like pure fantasy to anyone listening in early 2024, and that even after a dollar bounce strong enough to rattle the entire precious metals market, gold is still holding $5,100, I need you to understand something is fundamentally broken in the old rules. Or more precisely, the rules have changed, and most people watching this video have not caught up to that change yet. By the time you finish this video, you're going to understand exactly why gold held above $5,000, even with a resurgent dollar. You're going to see the specific data points, not opinions, not predictions, documented numbers, that explain why this isn't a fluke and why the institutions that matter most are positioning accordingly. And you're going to understand what this means for you personally, what the next 12 months likely look like based on historical patterns, and what to watch for. Let's start with what actually just happened. On March 9th, 2026, precious metals got hit hard. Spot gold fell 2.5% in a single session, settling at $5,041.89. Silver took an even harder shot, dropping 4% to close at $80.99. The proximate trigger, as analysts at USA Gold noted in their daily market commentary, was a double whammy. The US dollar index surged to 99.69, a 3-month high, and Treasury yields climbed simultaneously. In a normal market with normal gold dynamics, that kind of dollar surge would have gold retesting 4,500, maybe lower. Instead, 3 days later, we're back at $5,160 as of this morning. Think about what that means. The dollar bounced hard, Treasury yields climbed, and gold gave back roughly 2.5% before immediately reversing. That's not weakness, that's a coiled spring. That's a market that wants desperately to go higher but is catching its breath. And the question you should be asking isn't, why did gold fall 3%? The question you should be asking is, why didn't gold fall 30% like it would have in 2019 when the dollar made the same kind of move? To answer that question, you need to understand something about the structural shift that happened between 2022 and today, because this isn't a normal bull market. This is a fundamental re-rating of what gold means to the global financial system. And once you see it, you can't unsee it. Real quick, before I get into the structural stuff, if you're not subscribed yet, my analytics tell me that about 3 out of every 4 people watching right now haven't hit that button. If this kind of data-driven analysis is actually cutting through the noise for you, hit subscribe. That's literally how I know who the committed community is here, and it helps the algorithm show this to more people who need to see it. Okay, back to it. Let me give you the historical framework first, because without it, the numbers I'm about to show you won't land the way they should. Gold has gone through 3 distinct re-rating cycles in modern history. Each one was triggered by the same combination of factors: sovereign debt stress, dollar credibility erosion, and institutional abandonment of the traditional monetary playbook. The first was 1971 to 1980. When Nixon closed the gold window in August 1971, gold was fixed at $35 an ounce. By January 1980, it hit $850. That's a 2,328% increase in less than a decade. The trigger wasn't just inflation, it was a fundamental loss of confidence in the dollar's anchor. The second re-rating was 2001 to 2011. Gold went from $252 in 2001 to over $1,900 in 2011. Again, it wasn't purely about inflation. It was about the dollar losing ground as the uncontested global reserve currency, following the dot-com collapse, the Iraq War, and then the 2008 financial crisis. And now we're in the third re-rating. Gold started 2025 at approximately $2,624. By October 2025, it had crossed $4,000 for the first time in history. By January 29, 2026, it hit $5,595.42, an all-time record. 1 year, from 2,600 to 5,600, a gain of over 74% in 12 months. That's not a trade, that's a regime change. Now here's what makes this cycle different from the first two, and this is the part that most mainstream financial commentators are missing entirely. In 1979, When gold was in its final parabolic surge, the buyers were largely Western retail investors and speculators. In 2008 to 2011, the buyers were a mix of ETF investors, hedge funds, and some early central bank accumulation. In this cycle, this 2022 to 2026 cycle, the primary structural buyer is sovereign central banks, and not small ones. According to World Gold Council data published earlier this year, central banks have now completed their 15th consecutive month of net purchases. The People's Bank of China has been buying gold every single month for 15 months straight. Goldman Sachs, in research they published just weeks ago, estimates that central banks are now averaging 60 tons of gold purchases per month. 60 tons per month. For context, the pre-2022 average was 17 tons per month. That means central bank demand has more than tripled in just 4 years, and it's been sustained at those elevated levels even as gold crossed $5,000 an ounce. Let me put that in dollar terms so you can feel the weight of it. 60 tons of gold per month at current prices is roughly $10 billion of institutional buying. Every single month. Just from central banks. Before you count a single ETF inflow, before you count a single retail buyer, before you count the hedge funds and family offices. Now let me show you the ETF data, because this is where the story gets truly extraordinary. According to the World Gold Council's ETF report for January 2026, global gold ETFs saw their strongest year of inflows ever recorded in 2025. Total annual inflows hit $89 billion, the largest ever recorded in the history of gold-backed ETFs. Global gold ETF assets under management doubled to an all-time high of $559 billion. Physical holdings held by ETFs reached 4,025 tons by year-end, up from 3,224 tons at the start of 2025. That's 800 tons of new physical gold demand from ETFs alone in a single year. Goldman Sachs noted in recent research that Western ETF holdings have climbed by approximately 500 tons just since the start of 2025. But here's what they found even more significant. There's a new category of buyer that barely existed before this cycle. They described it as physical purchases by high net worth families, using gold specifically as a hedge against macro policy risk. And Goldman's language here is precise. They said this demand has become sticky, not speculative, not momentum-driven, sticky, structural, permanent. When Goldman Sachs uses the word sticky to describe demand in a research note, that's them saying, this floor isn't going away. Now I want to talk about the disconnect that's been showing up in the data over the last few weeks, because this is the smoking gun for why the dollar bounce didn't kill gold the way everyone expected it to. On March 9th, when the DXY hit 99.69 and gold fell to $5,041, the paper market was doing exactly what paper markets do, reacting to the dollar move, repricing contracts, triggering stop losses. Standard stuff. But simultaneously, look at what was happening in the physical market. China's National Bureau of Statistics reported that February consumer prices rose 1.3% year over year, the largest jump in over 3 years. That's inflationary pressure building inside the world's largest gold-consuming nation. But buried inside China's producer price breakdown, the USA Gold report on March 11th flagged something most people completely missed. Factory gate prices for silver refining in China surged 16.9% year over year in February. Gold refining costs jumped 8.4% year over year. Those aren't spot price moves. Those are the costs to physically process and refine metal inside China's industrial supply chain. Fabricators are absorbing serious margin compression. Upward pressure on finished goods prices is building inside the physical market, independent of whatever the paper COMEX is doing on any given day. This is the split that sophisticated gold investors watch for. The paper market can be pushed around. Futures contracts are leveraged instruments. A big enough dollar move, a big enough treasury yield spike, you can push the paper price down fast. But the physical market, the actual metal, the refineries, the vaults, the delivery queues, that moves slower, and it tells you the truth. Stick with me here because I want to walk you through the exact price path we've seen since January, because it illustrates the pattern perfectly. Gold hit its all-time high of $5,595 on January 29, 2026. Then what happened? Strong U.S. employment data came out and gold corrected. Hard. By early February, it had pulled back to around $4,400, a roughly 21% correction from the all-time high. At that moment, every financial media outlet was writing "gold bubble bursts" stories. Every talking head was saying the rally was over, the dollar was back, the safe haven trade was done. And then, from that 4,400 level, gold staged one of the fastest recoveries in its modern history. Within weeks, it was back above $5,000. By February 27th, it was at 5,210. By this week, March 12th, we're at 5,160. Gold climbed from 4,400 back to 5,100 in roughly 5 to 6 weeks. That's a move of approximately 16% from a catastrophic correction low. And this happened while the dollar was still bouncing, while yields were still elevated, while the Fed was signaling it would hold rates steady at its March 18th meeting. That recovery pattern, the violent correction followed by the rapid recapture of losses, is exactly what JPMorgan's research team described when they said the structural drivers are not exhausted. Their year-end 2026 target is $5,055 on average for the final quarter, with Goldman Sachs now targeting $5,400 by December. And if you average those two forecasts, you're looking at roughly $5,200 by year-end from major institutional research desks. Gold is currently at $5,160. That means the major Wall Street houses think gold is roughly fair valued, at current prices, at the top of a historic bull run. That's extraordinary. Now let me talk about the factor that nobody in mainstream financial media is connecting properly to this gold story. And that's the de-dollarization trend that's accelerating underneath the headlines. The World Gold Council published research just in late February that laid out the dollar picture clearly. On a real effective exchange rate basis, the US dollar remains expensive relative to historical norms. The double reward that foreign investors had for years, strong US equities plus a strong dollar, is fading. Europe and Japan are now offering genuine alternatives, and there are early signs that some foreign investors are beginning to rotate. Not catastrophically, not in a way that's crashed the dollar, but the rotation is beginning. And when you think about what that means for gold priced in US dollars, a weaker dollar directly raises gold prices because it enhances purchasing power for every non-dollar buyer on the planet. The 2 billion people in India and China buying gold don't buy in dollars, they buy in rupees and yuan. When the dollar weakens, gold gets cheaper for them, demand goes up, and the price in dollar terms rises. The World Gold Council's February 2026 commentary put it plainly. The DXY bounce is likely short-lived, and the resumption of the dollar's downtrend is a key positive force for gold prices going forward. Their words, not mine. This is the institution that tracks gold demand globally, and they're saying the dollar's 3-month high is a temporary respite, not a turning point. Here's what makes this truly alarming for anyone who thinks gold has peaked. Let's talk about supply. JPMorgan's research team made a critical point in their most recent gold outlook. Gold mine supply is, and I'm quoting from their research here, relatively inelastic and slow to respond. What that means in plain English, even with gold at $5,000 an ounce, mining companies can't just flip a switch and produce dramatically more gold. New mines take 7 to 15 years to develop from discovery to production. Existing mines are depleting. The all-in sustaining cost of production, the cost to actually pull an ounce out of the ground, process it, and deliver it, has risen significantly. And here's the supply dynamic that should make you sit up straight. JPMorgan ran a scenario in their research where just 0.5% of foreign US asset holdings globally rotated into gold. Not 5%, not 10%, half of 1%. Their finding? That incremental demand alone would be enough to push gold to $6,000 an ounce. 0.5% rotation. In a world where foreign investors hold tens of trillions in US assets and are actively questioning the dollar's trajectory, that scenario isn't a stretch. It's arguably already beginning. Let me give you the institutional positioning picture right now because this is where the smoking gun lives in this story. Goldman Sachs recently raised their December 2026 gold price forecast to $5,400, up from $4,900 previously. That's a $500 upward revision in a single update. When Goldman raises a major commodity target by $500, that's not a routine adjustment. That's a fundamental reassessment. They cited hedges against global macro and policy risks becoming sticky, that word again, as the reason. They're saying the demand that drove gold to these levels is not going away. UBP, Union Bancaire Privée, one of Switzerland's largest private banks, with roughly $140 billion in assets under management, published a target of $5,200 for year-end 2026. Wells Fargo has recently upgraded their gold target to a range of $6,100 to $6,300. Let me say that again. Wells Fargo. a mainstream American commercial bank that manages wealth for millions of ordinary American families. Their gold target is $6,100 to $6,300. That's not a gold bug fringe prediction. That's a regulated financial institution's published research. And JPMorgan, forecasting prices to average $5,055 in Q4 2026, with a stated path toward $5,400 by end of 2027. Their Q4 2026 average implies gold will be higher than it is right now for the final 3 months of this year. Now I want to show you the historical pattern that tells you what comes after a cycle like this one. Because 3 times in modern history, gold has gone through a re-rating event similar to what we're experiencing, and the pattern after the initial shock higher is remarkably consistent. In 1980, gold hit $850 in January, then corrected violently, falling 70% over the next 2 years. But here's what people forget. It took until 2008, 28 years, for the geopolitical and monetary conditions that created that 1980 spike to truly reassert themselves. The cycle was long, but it was durable. In 2011, gold hit $1,900, then corrected sharply, spending 4 years below $1,500. Again, a violent correction following the peak. But again, the structural case for gold, fiscal deficits, central bank money printing, dollar credibility questions, those structural factors didn't go away. They went dormant for a while, and then they came back stronger than before in 2018, 2020, and especially 2022. What's different this time, and this is crucial, is that the structural buyers in this cycle are not retail speculators who can panic and sell. Central banks don't panic sell. They don't get margin calls. They don't have institutional clients demanding redemptions. The People's Bank of China buying 60 tons a month is not going to sell that gold because the DXY bounced to 99.69. That gold is going into the vault and staying there. When your structural buyer base shifts from retail speculators to sovereign institutions, the floor for prices rises dramatically, and the violent corrections of prior cycles become less severe. Now let's make this personal because I want to talk about what all of this actually means for you watching this right now. If you're currently holding gold, whether that's physical, ETF, mining stocks, or a combination, the data I've walked you through today suggests you're holding an asset whose structural demand base is the strongest it has ever been in the modern era. Central banks buying 60 tons a month, global ETFs holding a record 4,025 tons, Goldman Sachs describing demand as sticky, the World Gold Council calling the dollar bounce temporary. Your primary risk is not that gold goes to zero. Your primary risk is volatility. The very real possibility that gold could correct 15 to 20% from any given high before resuming its structural uptrend. We saw exactly that in February. 21% correction from the January high, followed by a rapid recovery back above 5,000. If that kind of volatility would cause you to make panic decisions, you need to size your position accordingly. And always, this is not financial advice. Talk to an actual financial advisor about your specific situation. If you're on the sidelines watching this and wondering whether you missed the move, JPMorgan, Goldman Sachs, Wells Fargo, and UBP all have year-end targets above current prices. The lowest major institutional target I've cited today is JPMorgan's $5,055 Q4 average, and we're currently at $5,160. So the consensus view from the largest financial institutions on Earth is that gold is roughly fairly valued right now. Not cheap, but not at a peak either. What matters more than price timing is understanding why you'd own gold, as a hedge against fiscal stress, dollar weakness, and geopolitical risk. If those conditions persist, and there's currently no data suggesting they're fading, then the reason to own gold remains intact, regardless of whether you bought at 2,000 or 5,000. There are 5 things I want you to specifically watch over the next 30 to 90 days that will tell you whether this gold bull market is entering its next acceleration phase, or whether we're in for a deeper corrective consolidation. First, the Federal Reserve's March 18th meeting. The Fed is broadly expected to hold rates steady, but the language in the statement matters enormously. If they signal any pivot toward cutting rates earlier than expected, if they start dropping hints that growth concerns are outweighing inflation concerns, gold will respond immediately and violently to the upside. Because lower rates reduce the opportunity cost of holding gold, which pays no yield. Conversely, if they signal higher for longer and sound hawkish about inflation, you could see gold test the 4,800 to 4,900 support level that analysts have flagged. Second, the DXY. Watch the 98 to 99 level on the dollar index. The World Gold Council explicitly said the medium-term dollar fundamentals remain tilted toward downtrend resumption. If the DXY fails to hold above 99 and starts rolling over, that's going to be a tailwind for gold that could push it back toward the January all-time high quickly. Third, central bank purchase data. The World Gold Council releases monthly data on central bank gold purchases. If the People's Bank of China continues its buying into month 16, the data for February will be released in the coming weeks, that's a continuation signal. If they pause, watch out for a sentiment shift. Fourth, U.S. CPI data. The February CPI number is being released this week. This is a massive catalyst. Hot inflation, higher than expected, is net neutral to positive for gold because it reinforces the inflation hedge narrative. Weak inflation could strengthen the dollar and pressure gold. But here's the nuance. If inflation is hot and the Fed stays hawkish, that's a stagflation setup. And historically, stagflation is actually the most bullish environment of all for gold. It's the scenario the market is most unprepared for. Fifth, the Strait of Hormuz and Middle East geopolitics. Multiple reports this week indicate Gulf equity markets are under pressure as investors cut exposure to Middle East-linked assets. Qatar's energy minister has made statements about potential disruption to Gulf energy exports. If oil spikes to $150 a barrel on a supply shock, which Qatar's energy minister suggested was possible within weeks in comments to the Financial Times, you get an inflationary surge that would make the current gold price look cheap. Watch this closely. I want to come back to where we started because I think the full picture is now clear. $5,147. Gold, today. While the dollar is bouncing, while yields are elevated, while the Fed is holding rates steady. That price exists not because of panic or speculation or mania. It exists because the structural buyers, 60 tons a month of central bank purchases, $89 billion of ETF inflows in a single year, physical buying from high net worth institutions described by Goldman Sachs as permanent and sticky. Those buyers are not going away when the dollar bounces. They don't care about the DXY at 99.69. They care about whether U.S. Treasury bonds remain the world's safest long-term store of value. They care about whether the dollar will be worth as much in 10 years as it is today. And the institutional consensus, from JPMorgan to Goldman Sachs to Wells Fargo to the World Gold Council, is that those structural questions are far from resolved. Gold started 2025 at $2,624. It ended 2025 at approximately $4,325, a 66% gain, the best annual performance since 1979. It then surged to $5,595 on January 29th before correcting and recovering. And today it sits at $5,160, still nearly double where it was 14 months ago. The historical pattern from the prior two re-rating cycles tells us these moves don't end quickly. The 1970s re-rating took 9 years. The 2001 to 2011 re-rating took 10 years. We are approximately 4 years into this one. JPMorgan sees the path toward 5,400 by the end of next year. Wells Fargo is targeting 6,100 to 6,300. And the scenario analysis from JPMorgan themselves shows that a mere 0.5% rotation of foreign U.S. asset holdings into gold gets you to $6,000. The people who watched gold go from $250 in 2001 to over $1,000 in 2008 and said, "This is a bubble." They were sitting at $1,200 in 2010 saying, "I should have bought at $500." The people sitting at $3,500 in 2025 saying, "Gold is expensive," are sitting at $5,100 today. The question isn't whether $5,000 is expensive relative to where gold was. The question is whether the structural forces that drove it from $2,600 to $5,500 are exhausted. And based on everything I've shown you today, the central bank data, the ETF flows, the institutional positioning, the dollar fundamentals, the supply constraints, the answer from the largest financial institutions on the planet is a clear and documented no. One final thing before I let you go, and I want you to genuinely think about this before you close this video. In 1972, a year after Nixon closed the gold window, the average American had no concept that gold was about to multiply in price by 24 times over the next 8 years. In 2001, when gold hit its cycle low at $252, the average investor was convinced technology stocks were the future and gold was a relic. In both cases, the signs were there for anyone who looked at the structural data. The fiscal deficits were growing. The dollar's credibility was eroding. Institutional behavior was quietly shifting. The mainstream narrative hadn't caught up to reality yet. Right now, today, the mainstream financial narrative is still processing the idea that gold at $5,000 is elevated. The institutions, JPMorgan, Goldman Sachs, Wells Fargo, the World Gold Council, are talking about 5,000, 400, 6,000. The People's Bank of China is buying 60 tons a month. Global ETFs hit a record 4,025 tons. And yet gold just fell 2.5% on a dollar bounce, and the headline said, "Gold tumbles amid dollar strength." The DXY bounce is the noise. The central bank buying is the signal. The only question is whether you'll be positioned to recognize which is which. Drop a comment below and tell me this. Do you think the dollar bounce we saw on March 9th represents a genuine turning point for gold, or just a short-term correction in a structural bull market? I read every single comment on these videos, and the conversation in the comments genuinely shapes what I cover next. Your perspective matters here. If this kind of research-driven breakdown cut through the noise for you, hit subscribe. About 3 out of 4 people watching right now haven't yet, and that button is the only way to make sure you don't miss the next one. The Fed meeting on March 18th is going to be a major catalyst in either direction, and I'm going to break down exactly what the statement means for gold the moment it drops. You don't want to be processing that through a 30-second news clip. You want the full picture.